Our next guest's career in financial services spans nearly 4 decades. Her name is Walsh. She is Chief Investment Officer of Guggenheim Partners Investment Management, who guides the firm's investment strategies. And I'm thrilled to say that she joins us now. And it's great to see you.
Great to see both of you. Thank you for having me.
So let's start right there on that conversation Romaine and I were having. I mean, you think about these equity markets. March was a hairy month, but then you saw what happened in April. And you think about where we are when it comes to the bond market. Hasn't really retraced that sell-off. You think about where we are when it comes to oil. We're at very, very high levels relative to where we were a few months ago. Are you surprised by where we stand when it comes to U.S. public equities?
So I think that equities price in news, good or bad, rather rapidly. And what we're seeing, and if we go all the way back to the financial crisis, we go back to COVID, we're seeing this, or Liberation Day last year, we're seeing the snapbacks happen faster. The volatility is happening rapidly, and the recovery is happening with amazing speed. And that's really become a pattern for the equity market because of this pricing in. And right now, the equity markets have priced looking through the Iran conflict to its conclusion. And I think that's what's driving the equity markets, along with, dare I say, fundamentals. The storyline's pretty strong, and the U.S. economy remains resilient and positive.
Absolutely, and it's worth noting. I mean, you think about the latest round of earnings that we got through. We got a lot of the Magnificent Seven out of the way. Certainly, this opportunity to focus on the fundamentals of corporate America might help explain what we're seeing in the S&P 500. But even still, if we were to stay around these levels when it comes to Brent, when it comes to WTI, I mean, how much longer can this sort of dynamic last, where you have pretty high oil and you have an equity market that is paying attention to a totally different story?
So there's a few things here. So first of all, the downside risk, the extended Iran conflict really isn't priced in at this point in time. So there is some room for volatility in the future. Our base case is that we stay elevated on oil prices, let's say around $100 a barrel for, we'll call it 3 months. And during that period of time, we sort of slowly then, towards the end, tail back down, not to pre-Iran conflict prices. We don't really see a round trip to 60. It's going to take a little bit of time to unsnarl the supply chain disruption that came from having the straits closed. And so as a result, we're going to see maybe 80, which is about where the futures suggest by the end of the year oil prices will go. In that environment, that the markets can operate. Fixed income can operate too, and we'll talk a little bit maybe about where the fixed income markets are. But that's where equities have priced in. Again, looking past the conflict to fundamentals and the ability of the economy to recover, remain resilient, even in spite of elevated oil prices.
Well, let's talk about fixed income. I mean, spreads are still tight despite, I think, everything that's happened. So, I mean, you still have some resiliency there, same way you see in the equity market. So I am curious, do you expect at all any sort of widening of those spreads as this conflict continues for a longer period of time, or do we kind of stay where we are?
So I think fixed income is now more of a rate story than it is a spread story.
Okay.
Outside of technology. And what we're seeing is concern about inflation and Fed policy, and by the way, central bank policy around the globe and what's happening there, and the concern about whether they need to actually begin to dare I say, raise rates. And our view is that we still expect one rate cut later this year. But obviously the markets have priced that out. And we have, assuming all goes well, a new Fed chair in Walsh. And so I think we're going to see a change to the way the Fed manages interest rates going forward and thinks about inflation fighting, using different tools or using the same tools differently, if you will.
Right.
And so as a result, I think it's more of a rate story. What else is also happening is because of the Iran conflict and other fiscal spending that's happening, we're going to see more treasuries get issued. And so as a result, we're seeing sort of a lift to rates because of a supply-demand, dare I say, imbalance. Way more supply coming relative to the demand, and that's lifting rates. That, however, isn't affecting spreads. So the spread story is one where the fundamentals, the same market conditions that are driving, dare I say somewhat optimistically, driving driving stocks are also driving the spread story relative to rates.
You mentioned how the Fed is going to maybe think a little bit different about inflation fighting, but there's also been a lot of talk, based on what Kevin Walsh has said publicly, just about thinking about what inflation is altogether, at least in the context of monetary policy. When you think about whether it's productivity enhancements and other things coming into the economy, is there a case to be made that maybe the way we look at inflation at its current levels is, I don't want to say wrong, but maybe it's not the right way to think about it?
I think the issue is, do the tools that currently are the tools that are available to the Fed and to central banks, are they the right tools to fight this type of inflation? So if the inflation is one that's caused by supply chain snarls, I mean, to be real, there's a whole lot of oil available, many billions of barrels. But getting it out of the ground and getting it to where it needs to be deployed are two different matters. And so as a result, is the Fed using the right tools, or do they even have them available to fight that kind of inflation? I think the market is pricing in what I would call the pig through the python problem. So if all goes according to plan or expectations right now, what we're going to see is inflation bulge and then return down to at least some level that is closer to the Fed target. Do I see 2%, which is the Fed's target number, anytime soon? No. And in fact, we have to look at the bigger picture, which is, are we in a bit of a reflationary world anyway? All this building for AI, all this need for capital, these are different types of drivers than necessarily the Fed's situated to take care of. And so I think that's one of the reasons that Walsh is really interested in and has written a lot about how do we really address these tactically, and what tools does the Fed have available to it to address them?
So, I mean, how does that change your thinking about how you're viewing, U.S. government bonds as an investor? Because, you mentioned a whole lot of elements here, which sounds like it leads to maybe a structurally higher long end of the Treasury curve. Does that change any assumptions that you have about, what role that plays when you're putting together a portfolio?
So, interestingly enough, what we've seen is a flattening of the yield curve, and I think what we're going to see is a lot more issuance in the short end. So perhaps what we're going to see is this flatter yield curve becomes a bit of more of a phenomenon relative to frankly, even our prediction that we were going to see a steeper yield curve. At the beginning of the year, that certainly made a lot of sense. Given where we are now, the flatter curve probably is the story. Oddly enough, also, what we've seen is the 10-year remains anchored. And it's been anchored running between high 3s and high 4s for a long time now, since 2022, really. And so as long as we're within that space, investors can actually tactically move duration, which is what we've done. As interest rates move up to the, say, 4.5 level on the 10-year, or maybe a little bit more, that's the time to extend duration. Frankly, the economy and tech and other markets, stock market, for example, really don't perform well when the 10-year goes north of 4.5%. So keeping it in that range, I think, makes a lot of sense, and I suspect that Fed policy and more likely Treasury policy will have a goal to keep the 10-year within that trading range.
With regards to Treasury policy, I mean, how do you rate it so far? I mean, I know there's a lot we don't know, but at least from what we can see, it does appear that Bessent has done a relatively good job so far of trying to thread this needle.
Actually, I mean, I think he actually has done a very good job, considering there's been so much headline news. There's been a lot of deficit spending. And they have to signal. The Treasury has to signal when they're issuing and how much. And I think it's been very transparent. And I think, in fact, the Treasury Secretary has done a great job.
All right, and always appreciate you taking time. Always great insights. And Walsh is the Chief Investment Officer of Guggenheim Partners Investment Management.